Okay, now we will continue. So we have completed the question, and what was the number of that question? That was 4.4. Question number 4.4 in target costing. Then I have given one more question, that is 4.5. Again, very similar to the previous problem which we did. There are some proposals to cut down the target, the actual cost to the target cost, and how it is impacting the cost situation. That is what we need to comment on that. Okay. Now, anyway, this question also I am leaving for the time being. I will come back to all these questions which we have left in the class. Okay, don't worry on that. Now I am moving to the next topic. You can write the heading, life cycle costing. Heading, life cycle costing. A very small but very important topic. Okay, life cycle costing. Now, before we learn the meaning of this life cycle costing, we need to learn the concept of product life cycle. Again, this is some concept which we have already learned in your strategic management in your previous level. Okay. Now, for any product, once it is launched, it will pass through 4 stages in the economy. They are the stage 1, of course, it is the introduction phase. Stage 1 is the introduction phase. Then okay, then next is stage 2. Stage 2 is the growth phase. After introduction, you are entering to the next phase, growth phase. Then you have stage 3. Stage 3 is nothing but the maturity phase. Okay, and stage 4 is nothing but the decline phase. Okay, decline phase. So stage 1 introduction, stage 2 growth phase, and stage 3 maturity phase, and stage 4 decline phase. Now, why this classification is important? Because depending upon the stage in which the product is right now, the cost structures will also change. Not only the cost structure, even the revenue structure and the profitability will also change. So if you don't know into which stage of that product life cycle the particular product belongs, if we take any decisions, that may be a wrong decision. Okay, because each of these stages has its own characteristics. So understanding that characteristics is very, very, very important. Okay, now first we will see what all are the features of the first stage, that is introduction phase. Introduction phase refers to the phase where the product is just launched. Okay, you have launched the product. Okay, so naturally, this is being the first time you are introducing the product in the market. There will be only minimum awareness in the market about the product. Minimum awareness about the product. So if there is only minimum awareness, naturally what will happen? There will be minimum competition. Minimum competition. Why minimum competition? Because you have just introduced the product. This product was not there in the market for in any of the previous periods. Okay, this is the new product, new concept. So due to which, when the competition will come, only after your product has been established, your competitors will start making or imitating you. So till then, you will be the only person, and there will not be any competition, or there will be only minimum competition. Okay, but unfortunately, in this phase, your profits will be almost nil or no profits, or rather you will be making losses. Because Why you are making losses? Because this is the initial phase of introduction phase, where you have just launched the product and you need to make awareness about the product. How you have to make awareness? Through advertisement, then marketing, okay, then promotional activities, etc. Then only your product will be known to the market and the customers will come and buy your product. Okay, so on one side you have to incur a lot of cost in the form of advertisement, then marketing, then promotional. The other side, since your product is not known in the market, you will not be getting good revenue. Okay, naturally your product will either will not make any profits or it will be making losses only. This is the characteristics of stage 1 introduction phase. So if your product is in introduction phase, you should be ready to invest for what? Inside of advertisement, then marketing, promotion. And the other hand, you cannot expect any returns also. If you expect returns and profits in the first phase, then you are going to fail. Okay, you will have to wait till your product is established in the market. Okay, so that is the peculiarity of stage 1, that is introduction phase. Now moving to the next phase, that is growth phase. Okay, stage 2, growth. What is the peculiarity of this stage? Here your product has entered from introduction phase to the next phase, where your product is known in the market, okay, and customers are aware, and they are buying your product, in increasing quantities. So naturally what will happen? Your sales revenue will be fast increasing. Okay, because more and more customers are coming to buy your product. Your product is established, or your product is known in the market, because we are spending a lot of on advertisement marketing. So it is known. People know what is the quality, what are the features, everything, what is the utility of your product. So they are buying. So naturally what will happen? The sales revenue will be fast increasing. Okay, now this is the phase where competitors will enter. Why competitors will enter? Because competitors also will be watching. They saw, yes, there is a new product launched and this product has got good potential, good profitability. So naturally they will also try to imitate you. So this is the area, or this is the phase where the competitors will come, enter into the market. Okay, now what will happen? The profits will be high initially. Within this phase, profits will be high initially. Why profits will be high? I would say not profits, it will be margins. Okay, profit margins. I would correct it. Profit margins will be high initially. Why? Because there is no competitor. So, and your product is accepted in the market, so you can charge your prices. Okay, so the profit margins will be high initially, but as the competitors comes, as the competition increases, there will be a price war. Which will result in reduction of profit margins. Okay, so towards the end of this phase, your profits margin will start decreasing or declining. Okay, why it is declining? Because competitors has come, and initially you had the benefit of charging high premium. Now it has to come down. It has to come down and it has to stabilize. Okay, so the margins have starting down. Now, what about the cost? Cost will be high. Why high? Because you need to spend towards advertisement, marketing, etc. Because this is your growth phase. Unless you invest in this phase, you are not going to reap benefit later. Okay, so you spend. Naturally, when you spend, your cost will be higher. Okay, so what will happen to the profits? The profits, even though your sales are increasing, due to high cost, your profits will be very meager, or you may even make losses. Okay, so you have to write here. I'm writing here profits. Okay, even though the sales revenue will be increasing constantly and sharply due to huge cost of advertisement and promotion, cost of advertisement and promotion, the entity will not be making any significant profits in this phase 2. Is it clear? Though your revenues are increasing, your sales volumes are increasing, your product is known in the market, you have started building your brand image, everything is good for you, but your cost is huge because you are investing heavily on advertisement, promotion, marketing, etc. Due to which your profits will be either meager or you will not be making any profits in this phase also. So even in this phase, just because your product is making losses, can you quit from the industry? No. If you do so, it will be a wrong decision. Okay, so you need to understand in which phase your product is. Depending upon that, you need to take a call. Okay, now next, what is the next phase? Stage 3. Stage 3 is nothing but maturity phase. Okay, this is the phase immediately after what? Immediately after your growth phase. Okay, now in this phase, your sales will be increasing. Okay, sales will be increasing. Now what about the features? Your product is well established and known. Okay, so no need of any huge marketing. Due to the marketing efforts you have taken in the previous stages, your product itself will sell in the market. Okay, you can see certain products in the market which will sell its own. They don't have to do any marketing, or they don't have to do any advertisement. You keep the product, it will just sell on. Okay, there are products like this because they are in the maturity phase. Okay, so the sales will be increasing, but there is one catch. The rate at which the sales increase in this phase will be lower than the rate in stage 2. Okay, obviously, because in stage 2 you are starting with a lower base only. Your sales volume was very low, so from that you are jumping. So the rate of growth of your sales volume will be huge in case of stage 2. But whereas once you reach stage 3, by the time you reach stage 3, you have already capitalized your market share. Okay, you have reached your market share. Now again growing at the same rate as that of stage 2, that is not possible. Okay, because of huge market share. Okay, so here you can add one more point. Market share already capitalized. Okay, so the rate of increase of sales in stage 3 will be lower than the rate of increase of sales in stage 2. Okay, now what would be the case here with respect to competition? Okay, competition will be very intense, very intense. But due to your market share, you have due to you have your market share, you have an upper hand in the market because you are there for many years. Your product is well known in the market. So even though there is competition, there are substitutes, intense competition, your product is known in the market and you have a brand loyalty. Okay, you have. Okay, now that is with respect to competition. Now what you have to do here, now with respect to sales revenue, the revenue will be increasing, but I told you the rate of increase will not be as much as high as in case of stage 2. But it will be increasing. Now what about cost? Cost will be less. Why? Due to lower advertisement and marketing or promotional activities. What is happening in this phase? Your product is already known in the market, so there is no need for you to do any aggressive advertising. Rather, you will only do a defensive advertising, defensive marketing for that matter, defensive marketing. So your cost in terms of advertisement, then promotion and marketing, it will be less as compared to your growth phase and even in the first phase of introduction phase. Okay, so here on one side your revenues are increasing, the other side your costs are reducing because of reduction in the advertisement and marketing cost. Okay, so naturally what will happen? What about your profits? Your profits will be maximum. So maximum profits and increasing profits. Maximum profits and increasing profits. So you can say that stage 3 is the stage where the entity make huge and or real profits, huge and real profits. Okay, so you cannot expect the entity to make profits in stage 2. No, that is not possible. Okay, if you look for profits in stage 2, then you will fail in that because you won't invest or you won't spend too much for the marketing. So naturally what will happen? Your sales will come down, your product will not be known in the market. So in stage 1 and stage 2, don't look for profit. You simply invest and try to develop your market share. You have a stage 3 where you have reached the maturity position where you can reap huge profits. Okay, and here though the product margins will be low. Why product margins will be low? Due to severe competition. Though these are low, due to high volume, your entity will be making huge profits. Okay, so the profits will be high. Okay, though what, your margins will be less. Okay, now moving ahead, next phase, stage 4, which is stage 4 decline. Stage 4 decline phase. Yes, this is the phase where your sales starts declining sharply. Sales volume start declining sharply. Okay, so what you will see is there is a drop in the demand. You can also see competitors slowly disappearing because the market is no longer attractive. What will happen to the margins? Margins will be very less because the maturity phase itself, the competition was very high. So there will be price wars, due to which you will be forced to reduce your margins and operate at very thin margins towards the end of the maturity phase. And once you start declining, once you start entering declining phase, the margins for your product will be very thin, due to which it is not at all attractive. So what will happen to the competition? The competitors will start getting away from this market and this segment, so that competition will be lower, but your sales will be lower. Sales volume will be declining. Okay, so what about cost? Cost will be low due to no advertisement or promotional activities. There is no need of doing any advertisement or promotions in this stage because your product has entered into the decline phase. Now it has to come down. Okay, so what you can do here is not to incur any cost, and you take your profits. The entity will be still making profits as the cost will be very less and optimal. However, the profits will be declining, and towards the end of the service, this stage, towards the end of the stage, your product will go out of the market forever. Okay, so here the profits will be there, but the profits will be declining profits. Okay, so what should be the strategy? The strategy should be diversify or launch new products in stage 3. Stage 3 itself. The moment you reach your maturity phase, it's time for you to diversify. Okay, if you diversify, what will happen? You can retain the market share with new products. So by the time your first product reaches the maturity phase, your second product or your another type of product should come in the market. Okay, and you should be able to capitalize on this new product by the time your the first product reaches the declining phase. So this will ensure smooth running of your entity. Okay, so you can write understanding about the various phases of product life cycle and the behavior of sales volume, revenue, then cost and profits within these stages or cycles is very essential to take an informed, efficient decision about the products. Okay, so if you don't know what are the features of this cost, revenue, then profits, or over these stages, you may end up in wrong decision making. Okay, so this has to be understood and this has to be known. Okay, now we are moving to the next, product life cycle costing. Okay, now what do you mean by product life cycle costing? Okay, before moving to this, let me tell you how a costing is done in normal scenarios. Okay, with the help of an example. Okay, suppose you are manufacturing a product P. Okay, you are manufacturing a product P. You have prepared the profitability statement. Of this product. Okay, how do you prepare the profitability statement? The profitability statement will be prepared like sales revenue. Okay, I will take it as revenue less direct cost. We will get the gross contribution or gross profit less indirect cost less fixed cost less marketing cost, then the difference will be profit. You have done it for year 1, then year 2, year 3. Okay, when you do this, generally what you will do, you will take the revenue and the cost for single years only. So if the product is in the initial phases like growth phases as well as introduction phases, most probably the profits will be showing in red. That means it will be losses or very meager. Okay, so if the profits are very meager continuously for years, naturally what will happen? The business decision will be to revisit production of A or production of product B. Why? Because it is making continuous losses or continuously the profits are not attractive. Okay, so you have to again see whether it is profitable to continue with the production. That is the normal decision making. But you see, suppose that product is in growth phase, okay, and the product is only going to be not in the market, or sorry, the product is in introduction phase, where the product is only going to be non in the market, and slowly it moves into the growth phase. Again, when the product enter into the growth phase, your marketing managers would have increased your spending towards the advertisement and those things to create a market share. Am I right? So your product will be within these two phases, due to which its profits are very meager. But as far as the board of directors or the management is concerned, every year they are bringing in additional investments. For what? For financing these losses. The company is making losses, and to finance these losses, the company is bringing, or the management is bringing, additional investments every year. So at some point of time, they may see why this is so. Okay, why this is so? We are bringing in additional capital and we are not getting any return. So they may think it's better to close down the operation. Such a decision may be taken. Am I right? Yes. That is the general decision making principle, because in the normal decision making, we take only years as a single independent periods. Okay, you don't see what was the position in the previous year, or you don't see what is going to be the position in the future years. The cost will be taken for a particular period, for a particular year independently, and the revenues also will be taken for an year independently, and the profits also will be computed for that year independently. Okay, so such an attitude or a costing system may turn out to be defective, especially where the cost of introducing and cost of establishing the market share requires huge investments. Most of the products nowadays requires huge investment in terms of advertisement and publicity. Okay, you take the case of Jio. What was happened in the case of Jio? Jio, when they launched initially, the company started giving too many advertisements. So naturally, what will happen? The expenses will be huge. Okay, but the market is being developed slowly. Okay, the market is getting developed. So by taking that profitability for that particular year, if the management feels, see, we have invested so many crores of rupees and still we are not able to make any profits, so let's shut down the business. Will it be a wise decision? No, it will not be a wise decision. Okay, so product life cycle costing advocates that any decision with respect to a product should be taken only after considering the entire expected cost and revenue of the product over the entire life cycle. Okay, so any decision has to be taken only after considering the cost and revenues of the product over the entire product life cycle. You take the cost of introduction, growth, maturity, and declining phases. You take the revenue for introduction, growth, maturity, and declining. You compute the profits thereafter, taking everything together. You see whether the profit is profitable. Okay, so you can write a product may depict unfavorable results in the initial phases of its life cycle. Okay, where the cost will be huge and the revenue will not match the cost. However, in the maturity and decline phases, the situation will reverse. Okay, the cost will be low and the revenues and profits will be increasing. Okay, will be increasing. Therefore, any decision with respect to the product should be taken after considering all the revenue and cost of the entire product life cycle. Okay, so this is the theory. Is it clear? Yes. So what we will do, I've given certain theories in the material, very simple theories. I don't have to explain it, you can go through it. I will quickly move to the problems. Okay, so you can take page number, I think page number 10, question number 4.6. Questions also will be comparatively easier, so you can read question number 4.6. Okay. Okay, we will read the question. Y Connections, China-based firm, has just developed ultra thin tablet S5 with a features like ability to open two apps at the same time. So the company has developed a new product. What is that? It's a tablet. It's a tablet. Some features are there with the tablet. Okay, ultra thin tablet which will enable the tablet to open two apps at the same time. Okay, then going forward, the tablet cost rupees 5 lakh to develop. So development cost, the development cost what is the development cost? It's 5 lakh. Okay, then going further, it has undergone extensive research and is ready for production. So now it is ready for production. Ready for production. Okay, Now what else? Currently the firm is deciding on plant capacity, which could cost either 35 lakhs or 52 lakhs. Okay, so the company is currently has to take a decision with respect to the plant capacity. Okay, plant capacity means how many number of units should be producing. Okay, and there are two options, option 1 and option 2. The option 1 will cost around 35 lakh and option 2 will cost 52 lakh. 52 lakhs. Option 1 35 lakhs and option 2 52 lakh. Okay, now the additional investment of 35 to 42 17 lakhs, okay, will help the additional outload would allow the plant to increase the capacity from 500 units to 750 units production. So here it is 500 units, here it will be 700 units. Okay, and the relevant data for the life cycle of the tablet at different capacity levels are as under. This is 500 units capacity and here it is 700 units capacity. Selling price is given 79,600 and 69,600. Variable selling cost will be 10% of selling and as SP, then 10% of selling price here also. Salvage value of the plant, here it is 6,25,000 and here it will be 9 lakh. And PV ratio in both the cases it is 40. Advise the company regarding the optimal plant capacity to install. Tablet's life cycle is 2 years. Ignore the time value of money. Okay. So what are you required to do? Compute the profit of the product over the life cycle under both the options. Okay, both the options. And what you have to do? Select the option with highest profitability. Highest profitability. Is it clear? Yes. Now how to do that? You need to do the computations. Okay, so first if you first what you have to do, we have to find out the variable manufacturing cost. Am I right? Okay, because there is some information given here. What is the information? If you see, they have given the selling price, then they have given you the variable selling cost. Mind you, this is variable selling cost. Okay, they have not given you what? The manufacturing cost. Okay, so first you have to find out the manufacturing cost. How do you compute the manufacturing cost? You know what is the PV ratio. Okay, using which you can compute what? You can compute the contribution per unit, and you know what is the total variable cost. You can find out. From that you reduce the variable selling price, you will get the variable manufacturing cost. Okay, so you can write here total variable cost is equal to how much? Variable production cost plus variable sales cost. Am I right? Okay, so computation of variable cost. Okay, you have the capacity, (750 units) and 500 units and 750 units. (500 units and 750 units. Okay, so sales price per unit for the first it is 79,600 69,600, 79,600 and 69,600. Then you have the PV ratio. What is the PV ratio? PV ratio is 40%. Okay. So if you apply the PV ratio to the sales revenue, what will you get? You will get the contribution per unit. Okay. Contribution per unit, 79,600 into 40. So 79,600 into 40. If you find out, if you apply the variable cost ratio, we will directly get the variable cost. That is different. But here I am finding out the contribution. Contribution will be 31,840. 31,840. And here it will be how much? 69,600 into 40. That is 69,600 into 0.4. That will give you rupees 27,840. Okay, now what do you have to do? Total variable cost per unit. How do you get the total variable cost per unit? It will be sales price per unit minus contribution per unit. Okay, so that is nothing but 79,600 minus 31,840. 31,840. This will give you 47,760 here, and here it will be 69,600 minus 27,840. You will get 41,760. 41,760. Is it clear? That is the variable cost. Now less. Is it clear? 69,600 into 0.6 will be 41,760. Then 79,600 into 0.6 will be 47,760. Okay. Less sales, variable sales cost. Variable sales cost. What is the variable sales cost? This is a 10% of selling price. At 10% of selling price. How much it will be? It will be 10% of selling price will be 7,960 here and 6,960 here. Okay. So manufacturing variable cost. Variable cost per unit. Manufacturing variable cost per unit will be how much? 47,760 minus 7,960. That will give you rupees 39,800. Then here it is 41,760 minus 6,960. This will give you 34,800. Tell me friends, the variable cost is also different in both the cases. Will it be so? Can you expect such a situation? Yes, obviously, because when the capacity changes, the production process may change and there could be some changes in the activities contributing to the variable cost. So naturally, the variable cost may also change. Okay, so here the variable manufacturing cost has also changed. Is it clear? So here it is 39,800, here it is 34,800. Okay, now what is the requirement of the question? The requirement of the question is advise the company regarding the optimal plant capacity. So you need to find out what is the profit, okay, in each of the case. So statement of expected profit. Okay, you can write capacity in terms of number of units. In the first case it will be 500 units and in the second case it will be 750 units, right? selling price per unit will be 79,600 and 69,600. Okay, less variable cost per unit. What is variable cost per unit? Variable cost per unit 47,760 47,760. Then here 47,760 okay, here it is 41,760 41,760. Okay, so you will get the contribution per unit. Contribution per unit will be how much? Contribution per unit will be 31,840. 31,840, sorry, 31,840 and 27,840. 27,840. Okay, so total contribution will be 31,840 into 500, that is 1,59,000 20,000, and here it will be 27,840 into 750. Okay, that is 22,880,000. Okay, then what you have to do, this is the revenue. Now there is something called salvage value. Okay, this is for how many years? This is for 2 years. Okay, you have to assume that whatever details are given, this is for the entire, whatever information is given here, that has to be thought for the entire 2 years. Okay, we will write an assumption on this. Okay, so what you have to do here is, there is some salvage value for the machineries at the end of the period, that has to be added with the contribution because it is an inflow. Okay, so add salvage value. What will be the salvage value? Here it will be 6,25,000 and here it will be 9 lakh. Okay, so that is the salvage value. So total revenue inflow, okay, will be 1,59,20,000 plus 6,25,000 will be 159,820. So 159,20,000 plus 6,25,000. So it is 165,45,000, and here it is 208,800 plus 9 lakh. It will be 21,780. Okay, that is total revenue. Now less cost of machinery. Cost of machinery, here it is 35 lakh in the first case, and second case it is 52 lakh. Okay, so profit over the life cycle. Okay, 165, how much? 165 45,000 minus 35 lakh. It will be 130 45,000. Here it will be 217 80, 2 crore 70 lakh 80,000 minus 52 lakh. It will be 165 80,000. So tell me, which is the year, which is the product that is giving more profits, which is the capacity which is giving more profits. You will get more profits in the case of 750 units or additional capacity. So your recommendation would be, since the profits are high in the increased capacity, the company should install the higher capacity. Is it clear? Yes. Now there are certain points which you need to keep in mind in this particular problem. Okay, if you see the material which I have given, and this is a question which we have taken from the institute material, in both the cases the answers which has been computed is totally wrong. Okay, I will tell you why it is so. Okay, one. Okay, certain assumptions has to be not. Okay, as not number one, in the absence of specific information, it is assumed that the sales and cost data given are for the entire product life cycle of the product. Okay, that means if you see the question does not specify whether these details given are for 1 year or 2 years. So in the absence of information, we are assuming that these are for 2 years. We can take alternative assumptions also. Okay, that is one thing. Then second thing is, if you see the working what we have done, okay, I took the contribution, I found out the total contribution, and what I reduced from that is the cost of machinery. There is no fixed cost. Did you find any fixed cost? No. Nowhere it is they have mentioned anything about the fixed cost. So on that also you can write an assumption. Okay. In the absence of adequate information, the profitability has been worked out by reducing only the equipment cost. From what? From the total contribution. Okay, it is assumed that the fixed overheads, fixed costs other than fixed cost other than the cost of equipment. Okay, cost of equipment, if any, other than the cost of equipment, you can put it in brackets. Okay, if any, it is assumed that the fixed cost, if any, will be same under both the alternatives, and hence it will not affect the decision. Okay, what is the decision here? We are considering whether we should go for a capacity for 500 units or capacity of 750 units. These are the only two options. You have to select either one of the capacity. Okay, you don't have a choice to consider whether we should stop production at all. Such an option is not there. You are asked to advise whether they should select 500 units or 750 units. So while taking such a decision, any cost which remains same under both the alternatives is a irrelevant cost. Okay, so it is a irrelevant cost, and hence it will not impact in any manner your decision. Okay, so you can write any cost which does not vary between the given alternatives, okay, will not impact the decision in any manner. Okay, hence such costs are known as what? Known as irrelevant cost. Okay, now if you see the question, there is some information regarding what? Regarding the development cost. Development cost of 5 lakhs. Have you considered the development cost anywhere in this calculation? Have you considered? No, we have not considered. Why it has not considered? This development cost of 5 lakhs, which was already incurred. It was already incurred to develop the tablet. Okay, now do you think you can reverse that cost? No, it is already incurred, it is gone. Now you have got only two options before you. Either you select 500 units or 750 units capacity. Okay, your decision making is just limited to 500 units capacity or 750 units capacity. It is not going to be a decision whether to manufacture the tablet or not. No. If it was such a decision also, then this development cost is a relevant cost. That is already a different issue. But if that was the question, at least you would have taken this fixed overheads, if any. But here, the alternatives with you, available with you, are only either go with 500 units or 750 units. Whichever be the alternative you are going to choose, that is not going to change any of the cost which you have already incurred. Okay, so the development cost which has already incurred is a sunk cost or a past cost which will no way affect the decision making. Hence, it is not considered. Okay, so you can write the next point 3. The development cost of rupees 5 lakh was already incurred. It is a past sunk cost which cannot be reversed irrespective of the decision taken. Therefore, this cost is not considered for the analysis. Okay, Is it clear? So this is all about the answer. Now I would like to present this question in a very different manner. Okay, if you see the textbook solution and also the solution what I have given in the material, there what they have done is, here if you see the method in which we calculated, we computed the variable cost per unit. We computed the variable cost per unit separately for both the options. Okay, we computed separately for both the options. It was so because there was an information here. The PV ratio was given to be 40%. And if you see the manner in it is given, we can infer that this PV ratio is same for both the tablets produced. Okay, whether you have a capacity of 500 units or whether you have a capacity of 750 units, your PV ratio is not going to change, which means your variable cost ratio will also not change. Okay, even when you reduce your selling price, here the selling price is 79,600, here the selling price is 69,600. Even when there is a difference in the selling price under the given options, the PV ratio, the contribution ratio is not changing, which means what? The amount of contribution per unit or the variable cost per unit will be different in both the options. Is it clear? Okay, it will be different in both the options. Now suppose the PV ratio was different here. Okay, it was not given, it is not given. Okay, then probably what you will have to do, you will have to compute the variable cost over here using this PV ratio, and you have to apply that variable cost in this particular case and find out the other calculations. Let me tell you, that is the method in which this question is solved in the textbook, but I think that is wrong. Okay, even though I have given that answer in my material which I have supplied, I think that is a wrong assumption, because here if you see the question, I will if you see the question, here it is PV ratio 40% and there is no differentiation here. So the inference to be taken is this 40% PV ratio is applicable for this option as well as for this option. Okay, if you take that assumption, then whatever we have done is correct. Okay, the method in which it is done in the material is not as per that particular assumption. Is it clear? Don't get confused. Okay, you may when you go through the material, you may see that the answer is done, the question is answered in a different manner. Don't get confused. Okay, this is only due to this change in assumption. Okay, so you can write a note on this. Note. It is assumed that the given PV ratio of 40% is applicable for both the alternatives. That is 500 units and 750 units capacity. Okay, therefore the variable cost per unit of both the alternatives are computed separately. Okay, on the other hand, if it is assumed that the given PV ratio is applicable only for the alternative 1, only for the first alternative, that is 500 units capacity, comma, then the working of profitability will change. In such case, the variable cost per unit may be computed for alternative 1 first, and the same variable cost per unit may be applied for I'm writing here, maybe applied for the second alternative also. Okay, this is another assumption. Okay, right. So I think that question is over. Now we will have to move to the next question, question number 4.7. You can read the question 4.7. Okay, here you can make one small change here. Here against the manufacturing cost per unit, you can write variable. Okay. Okay, we'll just read the question once again. What is given here? Walmart International Limited is launching a new product Sigma in the current month. Okay. Walmart International Limited. Walmart International Limited is launching its product Sigma in the current month. The details of the product. Anticipate demand, it is 1,25,000. Then R&D cost 32,50,000. Then fixed manufacturing cost per annum 12,75,000. Fixed marketing cost per year, it is 6,72,000. Then warranty, I will come to that later. Selling price per unit 400 per unit. Manufacturing cost per unit variable. Even if it is not specifically mentioned as a variable cost, you may assume, because you have the fixed cost, manufacturing cost given separately here, so you can assume it to be variable in nature. That is 175. Marketing cost per unit, including 4% commission on sales, 90. Okay, this also you can assume to be variable. Then administration cost, rupees 6,60,000 per year. And warranty expenses, 4 replacement parts per 50 unit at rupees 30 per part. Okay, that is the warranty expenses. Now calculate life cycle cost of the product Sigma. Revised life cycle cost, if Walmart International increases the sales by 12% through 5% reduction in the selling price along with an increase in the fixed manufacturing cost by rupees 1,20,000 per year, should the company go for the reduction in the selling price? Very simple problem, direct problem. Okay, we will quickly do the problem. Okay, right. Now, what do you have to do? First, you need to find out the life cycle cost of the product Sigma. Statement of life cycle cost Sigma of Sigma. Okay, so first you should start with sales revenue. Though we are computing the cost, we will also compute the profit also. That is why I am starting with the sales revenue. Or you can do the cost first, then you come to the sales revenue. Okay. So sales revenue is, what is the anticipated demand given? Anticipated demand is 1,25,000. So 1,25,000 into, what is the selling price? Selling price is 400 per unit. Okay. So 1,25,000 into 400 will be 500 lakhs. 500 lakhs. Now less cost over life cycle. Okay. Now let me ask you, the sales anticipated demand, is it for 1 year or for the the entire life cycle? Is it not? It is not clearly given. Okay. So you can assume that this 1,25,000 is the demand for the entire life cycle. We will write a note on that later. Okay. Cost over the life cycle. Now first is R&D cost. Okay. Here the question is to find out the life cycle cost of product sigma, not to take a decision between which alternative is best. That is there in the second part, but the first part is to find out the life cycle cost. When you compute the life cycle cost, you have to consider all the cost, including the sunk cost or past cost which is already incurred, because the sole purpose is to find out the life cycle cost. Whether it is incurred or to be incurred doesn't matter. You need to consider all the cost. On the other hand, if the question was to compare two alternatives, okay, now anyway we have already incurred a lot of R&D, and now you want to take a decision whether to go with it or not, whether you go with the commercial production or not. If that was the decision to be taken, then you will not consider any irrelevant cost or any past cost or sunk cost. But here the question is very specific to compute the life cycle cost, which means you have to consider all the life cost incurred throughout the life cycle cost, whether it is already incurred or to be incurred. Is it clear? Okay. So R&D cost will be 32,50,000. Okay. Then we will take the fixed manufacturing cost per annum. Fixed manufacturing cost. What is the life cycle, the duration of this particular product? They say that it is given anywhere and it's with demand, then R&D cost, fixed manufacturing, fixed per year for replacement parts per 50 at 30, then marketing cost, manufacturing, selling price. Life cycle cost, revised life cycle cost, Walmart increases at 12% in the, along with the increase in the fixed cost per year. Sales reduction. Okay, so here you don't have any information regarding the life cycle, so you can write a sentence here. Okay, somewhere where we will write. Okay, before this you can write assume that the life cycle of the product will be 3 years. Okay, please write this in the question here. Before this, calculate. Assume that the life cycle of the product will be 3 years. Okay, then only you can complete these calculations. Clear? Okay. So fixed manufacturing cost, it is 12,75,000 per annum. So 12,75,000 per annum into 3. So that will come to how much? 38,28,000. 38,25,000. Okay. Then Next is fixed marketing cost. Okay. Fixed marketing cost. What is the fixed marketing cost? 6,72,000 per annum. Am I right? Into 3. 6,72,000 into 3 will be 20,16,000. Then what else? You have warranty expense that we will take later. Then you have variable manufacturing cost. Variable manufacturing cost. What is the total number of products? It is 1,25,000. This is over 3 years. Into what is the cost per unit? 175. So 1,25,000 into 175, that will be 1,25,000 into 175 will be 2,18,75,000. 2,18,75,000. Then you have something called what? Marketing cost, including 4% commission on sales. So first we will take the commission on sales. Commission on sales will be 5 crore into 4%, that will give you 20 lakhs. 20 lakhs. Then you have other variable marketing cost. Other variable marketing cost means total cost is 90. Okay, so that should be 1,25,000 into 90 minus what? This 20 lakh. Okay, so that will give you 1,25,000 into 90 minus, that is, this is 1 crore 12 lakh 50,000 minus 20 lakh. Okay, so this will be 92 lakh 50,000. 92 lakh 50,000. Okay, then marketing cost, fixed cost has already been considered. Then you have administration cost. It is 6,60,000 per year. Administration cost. Write in the next page. Administration cost is 6,60,000 into 3. That will be 19,80,000. Okay, then comes warranty cost. How do you compute the warranty cost? Warranty expenses, they say 4 replacement parts per 50 units at rupees 3 per part. So number of parts replaced will be 1,25,000 units we have already sold, and they say that 4 parts for every 50. Okay, so the total number of parts replaced will be 1,25,000 into 4 divided by 50, that is 10,000. It will be 10,000. So warranty cost will be 10,000 into 30 rupees, 30 per this one part, so 3 lakh. Okay, so altogether the total cost you have to add it one by one. 32 lakh 50,000 plus 38 lakh 25,000 plus 20 lakh 60,000 plus 2218 2 crore 18 lakhs 75,000 plus then you have 20 lakhs plus 92 lakh 50,000 plus 19 lakh 80,000 plus 3 lakh. So this will come to total cost of 444 lakhs 96,000. 444 lakhs 96,000. That is the total cost. Okay. Now what you have to do? We have the total revenue and total cost. So you can find out total profits. Total profits, total revenue is 500 lakhs minus 444.96. Okay, so that will be minus 444.96. Okay, so the profits will be 55 lakh 4,000. 55 lakh 4,000. This is the first one. Now, what is the proposal? Okay, this is the life cycle cost of the product sigma. They say that revised life cycle cost, if Walmart International increases the sales by 12% through 5% reduction in the selling price along with increase in fixed manufacturing cost by 1,20,000 per year. So they are thinking of making some changes to the cost structure and they are reducing the selling price by 12%. 5% so that the selling volume will increase by 12%. What would be the impact? That is what you have to compute. Okay, so the profits in the revised scenario. Okay, sales volume will increase by 12%. So that will be 1,25,000 into 112%. That will give you how much? That will give you 1,25,000 into 112% will be 1,40,000. And what about sales price per unit? Selling price per unit will drop by 5%. So it was 400 earlier into 95%. So 400 into 95% will be 380. That is equal to rupees 380 per unit. Therefore, total sales revenue is equal to 1,40,000 into 380. That will be 532. 5,32 lakhs. Okay, less life cycle cost. Will there be any change in the R&D cost? No. So research and development cost will be 32 lakh 52. 32 lakh 50,000 itself. Okay. Then fixed manufacturing cost. Will there be any change? Yes. They say that the fixed manufacturing cost will increase by 1,20,000 per annum. Okay. So earlier it was 12,75,000. So 12,75,000 plus 1,20,000 into 3. 12,75,000 plus 1,20,000. That is 13,95,000 into 3. That will give you 41,85,000. Okay, then coming to variable, before that let's take the next cost. This is the next cost. We can take fixed marketing cost. Okay, fixed marketing cost. Marketing cost will be, will there be any change in fixed marketing cost? No, it will be 6,72,000 into 3 itself. Okay, 6,72,000 into 3. Earlier also it was the same, 20,16,000. Here also 20,16,000. Then what else you have? You have to take the next cost, that is variable manufacturing cost. Variable manufacturing cost. Variable manufacturing cost will come down. Where is the reduction? The volume has increased. Am I right? Volume has increased. Okay, so it is 1,40,000 is the total volume. Okay, and what happens to the variable cost? The variable cost in the earlier case it was 175. Okay, so 1,40,000 into 175. Okay, so that will be, yes, it will increase because there is increase in the volume. 1,40,000 into 175, that will give you 2 crore 45 lakh. So that is variable manufacturing cost. Now commission. Commission is 4%. Okay, so 1,40,000, selling price has come down to 380 into 4%. How much? 1,40,000 into 380 into 4% will be 21,28,000. 21,28,000. Okay, now other variable marketing cost. Other variable marketing cost. They say that total variable cost is 90 including this 4%. Okay, so that will become 90 minus. Okay, here you have to be very careful. Here when you take the calculation, don't take 90 minus 380 into 4, because the variable manufacturing cost will not change merely because they change the selling price. Okay, is it clear? It's not going to change. They are not talking about the any changes in this particular thing. So here what you have to do, from 90 you have to reduce what? The previous commission itself. How much is that? 400 into 4%. Okay, 400 into 4%, that will be 16. Then this multiplied by how much? We have to multiply with 1,40,000. This is one change which you need to keep in mind. Okay, so 90 minus 16, 74. 74 into 1,40,000, that is 103,600. 103,600. Is it clear? Okay, then marketing fixed cost we have already considered. Then administration cost. Admin cost. Will there be any change in the admin cost? No. 6,60,000 into 3, that will come to how much? 19,80,000 itself. Okay, then warranty cost. So in that, number of parts to be replaced number of parts to be replaced will be, here how many units? 1,40,000 units into, for every 50 units it's 4 parts, so 4 by 50, that will give you 1,40,000 into 4 by 50, that is 11,200. And what is the cost? It is 11,200 into rupees 30 per unit. Okay, into 30, you will get it as 3,36,000. 3,36,000. So what will be the total cost? Okay, total cost will be 32 lakh 50,000 plus 41 lakh 85,000 plus 20 lakh 16,000. 20 lakh 16,000 plus 245 lakhs. 245 lakhs plus 21 lakh 28,000. Okay, 21 lakh 28,000. Then 103 6,000. Okay, 103 6,000 plus, then you have 19 lakh 80,000 plus 3 lakh 36,000. Okay, so total will be how much? Total is, did I make any mistakes? 32 lakh 50,000, then 41 lakh 85,000, then 2 crore 45 lakhs, 21 lakh 28,000. Yes, then 103 600, then 20 lakh 16,000. Okay, then 19 lakh 80, 3 lakh 36,000. So the total should be 32 lakh 50, 41 lakh 85, 20 lakh 16, 45 lakhs, 21 lakh 28,000. Okay, here it should be. Okay, so the total will be 487 55,000. Therefore, total profits is equal to, what is the total revenue here? 5 crore 32 lakhs. Am I right? Okay, so that will be 532 minus 487 55,000. That will give you 44 lakh 45,000. Okay, so what will happen to the profits? In the first case, the profit was 55 lakh 04,000. Okay, the profit was 55 lakh 04,000. Whereas in the revised scenario, it is coming down to 44 lakh 45,000. So you can write profits in the profits before price reduction. Before price reduction, it was 55 lakhs 4,000 less profits after price reduction. This will be 44 lakh 45,000. Okay, so loss due to price reduction. What is the loss due to price reduction? 55 lakh 04,000 minus 44 lakh 45,000, that is rupees 10 lakh 59,000. Okay, so therefore you can conclude that the proposed reduction in the selling price will reduce the total profits, the total profits of the company by rupees 10,59,000, and therefore is not viable. Okay, so that is the conclusion which we can give. Since the proposal is reducing your overall profits by 10,59,000, the said proposal is not viable. Is it clear? Okay. Now, going ahead, you have the other question. You have question number 4.8. Next question is 4.8. But in case of 4.8, you need to know the concept of learning curve effect. Okay, which I will be taking only later. So this problem I am keeping it pending. Okay, learning curve equations and learning curve effects, I will have to explain it later. I will take it later. Then I will include this problem also. Okay, so that is not required. Then there is one more question, that is question number 4.9. Okay, what we will do with 4.9. Okay, I will keep this question pending. Anyway, we have kept one question pending in all the topics, so we will take it later. You can try out this question your own. Okay, you try out this question, then we will discuss this question later. Okay, so question number 4.9, I'm marking it as homework for you all, right? Yes. Then we are moving to the next topic. You can write the heading Pareto Analysis. Very small topic. Pareto Analysis. Okay. Okay, we'll go ahead. It's a very small topics, Pareto Analysis, right? Now, let me give you an example. Okay, suppose you are taking your CA syllabus for SCMPE. You are taking the CA syllabus for SCMPE. You have huge volume of topics. Am I right? Huge volume of topics. You have almost 12 chapters, right? You have 12 chapters and you have numerous problems. Let us say you have 200 problems. It's only hypothetical situation. Though something is correct, I'm not, whatever I'm telling is not fully correct. It is only an example. Okay, you have 12 chapters and 200 or more than 200. Let us make it as 300 problems. Okay, now the exams are fast approaching in November. You thought you have only, let us say, 1.5 months for preparation. Okay, 1.5 months only preparation. You don't have adequate time to cover entire 12 chapters. No adequate time to cover the entire 12 chapters. Okay, so you know, if you start with your normal preparation style, like you start with chapter 1, you go with the institute material first, then you go to your reference, then you do the practice the problems. If you go by that strategy, you know that you will not be able to complete even 30% of the total chapters. You know that because you have other topics also to cover. Okay, so you are forced to do some sort of prioritizing. Okay, you know that within this limited period, we have not started your preparation for other topics also which you need to do. So it is not possible for you to have a 100% verification or 100% preparation for all these 12 chapters within this given time constraint. Okay, so there are certain constraints. Okay, there are certain constraints which forces you to have a prioritization. Okay, the constraint could be time or anything. Okay, you are forced to do some prioritization. When you do a prioritization, which means you are selecting few topics and you are going to prepare it. Okay, how will you select those topics? Okay, will you give a toss like 12 chapters are there, so let me take a lot. Okay, all 12 chapters we have the numbers and names have been written in the paper and you are taking a lot. Will you go by that? No, that is not a wise decision. What you have to do, if you are coming with a situation where you need to do some sort of prioritization, then what you have to do, out of this 12 chapters, okay, let us say you have something around 120 subtopics. On an average 10 subtopics per chapter, you have 120 subtopics. This is only a hypothetical situation. Don't think that you have 120 topics in subtopics in your entire SCMPE. No, I'm just giving you an example. You have this 120 subtopics. Okay, out of this 120 subtopics, ideally, okay, there will be some 20% topics which you can call it to be very highly important, very important topics. The normal manner which we used to do in our what do you call previous your exams, whatever exams you have appeared, you have certain core topics from where you will get maximum chunk of marks. Okay, so 20% of topics which are highly important. Why they are highly important? If you see, almost 80% of the marks will be asked from these 20% topics. Okay, I'm not talking about chapter wise. You take 20% of 12 chapters, it will be only 2.4 chapters. So you are only learning 2.4 chapters and you are able to get 80% marks. No, that will not happen. I'm going with the subtopics. There are 120 subtopics. Out of these 120 subtopics, there are 24 subtopics. Okay, which are core subtopics. Okay, and from this 124 subtopics, you will get around 80%, 70 to 80% marks. It is only a hypothetical situation. Okay, so balance 80% topics, okay, will give you only how much? 20% marks. If such a situation is there, then what you have to do? What you have to do? Your entire focus should be given to this 20% topics alone. And you just forget about this 80% topics because we are losing only 20% of the marks there. And you have a very limited time. Is it clear? So this is a rule of prioritization. Okay, if you have certain high yield topics, you concentrate on those high yield topics first. Then if time permits, you go to the other topics. Clear? Similar prioritization rules can be applied in your real-time situations also. You take the case of a particular, what do you call, manufacturing entity. This manufacturing entity, or let us say, forget about manufacturing entity, a trading concern. Okay, let us take the case of a trading concern. Okay, this trading concern is dealing in almost 100 items. Okay, almost 100 items. And this 100 items has huge stock. Okay, huge stock with the entity. Okay, now due to this huge quantity of stock, the entity is not able to exercise, not able to exercise what? Proper control over the inventory. Because due to the huge volume, if you want to do a physical verification, let us say it will take around 1 month's time. Okay, due to which physical verification is not effective at all. Numerous items and numerous quantity, you are not able to concentrate, you are not able to exercise any control. In such situations, what you can do is, whatever principle we saw here, you can apply the same principles here. If you take this 100 items, okay, out of these 100 items, 20 items could be marked as high priority items or high priority stock. Why high priority? Because 80% of value of the entire inventory will be this 20% of high priority stock. Similarly, you have 80% in volume numbers, okay, but this will constitute only 20% of value. Clear? This is a very common principle. Okay, so if you have this differentiation or classification, what you need to do, you need to have 100% control over this high priority, where you need to have only, let us say, 40% control over this. In other words, here you will have physical verification every month, on month-to-month basis, because it is only 20% of the items, so numbers are very less, and not only that, the value is very huge, so it is very much required to inspect it on a monthly basis because the value is huge, and it is not a difficult task because the numbers are very less. On the other hand, here the volume is 80%, so doing a physical verification is not feasible, it's not easy. Okay, not only that, these 80% volumes constitute only 20% of the value. So even if you restrict your physical verification once a year, you don't have to worry about it, as long as you have proper exercises, proper controls over this high priority items. Is it clear? This principle is what is given in Pareto analysis. Okay, Pareto analysis advocates that you focus on most important aspects, be it your inventory, be it your debtors, creditors. Okay, the same principle can be applied in debtors. You have a receivable of, let us say, 10 crore rupees as receivable. Okay, out of that 10 crores, maybe like around 7 to 8 crores will be from 20% of the people. So that 20% of the people, you have to be very careful and you need to follow it every now and then, because they constitute 80% of the value. Okay, on the other hand, balance 80% of the people, they may constitute only 20% of your receivables. So you don't have to worry about it, about that 20% much, because, or 80% much, because they constitute only 20% in value. Okay, so this principle, this Pareto analysis for advocates focus on most important aspects. Then if you focus on most important aspects, what is the benefit? You can simplify the process of decision making. You can simplify the process of decision making. How you can simplify the process of decision making? By prioritizing the challenges, and focusing on what? High priority. Okay, so for this, what you do, you employ 80:20 rule. Okay, what is this 80:20 rule? 80% of volume constitute only 20% value. However, However, 20% of volume constitute 80% of value. Okay, therefore, identify those 20% of volume contributing to 80% of value and exercise proper strict controls over such items or areas. Okay, this will be marked as high priority. High priority. Is it clear? And the balance, okay, non-prioritize the balance 80% of volume constituting only 20% of value. Is it clear? This is the Pareto analysis principle. Okay, now what is the usefulness or benefits of Pareto analysis? Okay, benefits of Pareto analysis. Number one, benefit number one, prioritize problems, goals, okay, and objectives. You, by applying this 80-20 rule, you are able to prioritize your problems, your goals and objectives. And not only that, this help you to identify the root causes of any problem. Is it clear? Root cause of problem, because you are concentrating only on those problems or goals or objective which is significant. Okay, then next, second one, select and define key quality improvement programs. Select and define key quality improvement programs. So if you have implemented Pareto analysis, you can tell, okay, these are the key quality improvement areas, the areas where I need to focus. These are the factors which I am more considered or more concerned. So I need to focus on that. So it will help you to select and define the key quality improvement programs or areas. Okay, programs or areas. Okay, next, what is the next benefit? Select the key customer relations and service programs. Okay, by applying Pareto analysis, you are able to classify your customers into two: low volume, high value, high volume, low value, and you are able to prioritize or focus on low volume, high value customers. So you try to improve your relationship between such customers. You give proper monitoring to that customers and do go as per their requirements. Okay, so that is selecting key customer relations and service programs. You can serve those customers better. Okay, next is select key employee relations improvement program. Same concept as I told you in the case of customers. You have 1,000 of employees. Out of the 1,000 employees, 20% will be the employees who is contributing to 80% of the value within the organization. So identify them, pick them, recognize them, concentrate on them, focus on them, train them. Okay, so you can select the key employee relations improvement programs. Okay, so improving the key employees and programs for that, that should be your objective. Okay, next, select and define key performance improvement programs. What do you mean by that? You may have a business have key performance indicators. Okay, performance indicators. There could be lot of performance indicators, sales volume, so many things. Okay, out of that performance indicators, you can identify key performance indicators. The basis on the basis of your benefit, 80% of value is from that 20% of the KPIs or key performance indicators. Okay, so identify those performance indicators and you give maximum thrust for that performance measurement or performance indicators and improving those indicators. Is it clear? So that is selecting and defining any performance improvement programs. Then next, help in allocating physical or financial or human resources. Yes, prioritizing, as in case of Pareto analysis, will help you to allocate your resources, whether it is physical, financial or human resources. You allot your resources to the high focus areas, okay, to your key customers, to your key employees, to your key performance measures. You focus only on that and you avoid or sideline the balance. Okay, that is Pareto analysis. Okay, then the areas where application of Pareto analysis comes. This is one area which you can expect as a question for your what do you call your pricing decisions. Okay, so application of Pareto analysis. Okay, which are the key areas where Pareto analysis are to be employed? One, pricing of the product. Pricing of the product. Okay, okay, what is the role of Pareto analysis in a pricing? Okay, if you have multiple products, if you have multiple products, okay, 20% of the products will contribute 80% of revenues. Okay, so what you have to do, management focus and attention should be diverted to this 20% of the products alone. Okay, and the balance 80%, you don't have to spend too much time on that. Okay, because for while you take the price decision for this 20% of the product, price decisions to be taken by top management, and the decisions with respect to balance 80%, who will take, you delegate that power, delegate to lower management. Is it clear? Very important, because you can save your management time. Okay, next, benefits is customer profitability analysis. Customer profitability analysis. What do you mean by that? In customer profitability analysis, again, you can divide your customers into 80%, 20%. 80% contribute how much? 20% value or revenue. Here contribute 80% value. So what you can do, The profitability needs to be measured only for this 20% value. Okay, focus. Okay, focus and improve the profitability. Okay, no bad debts. Then increase sales. Okay, whatever you want, you can do with respect to this 20% of the customers, which will increase your profitability. Okay, then next, in case of stock control, I have already discussed this. ABC analysis in inventory control. Okay, what you can do is you can classify your stocks into three categories. That is ABC analysis. Category A, category B, and category C. Category A will constitute 20% items. Okay, here this will constitute 40% and here 40%. No, 40. Here it is 30%, 40%. This is in volume, and in terms of value, this will constitute 50%, 30%, 20%. Okay, so this is volume and this is value. So what you can do, you can ignore this because this is only 20% value and the numbers is 50%. Okay, whereas here it is 30-30. Okay, so this is medium priority, whereas here 20% items and 50% value, this is high priority. So you can have constant inventory value checking on this category A, where here the periodicity could be even lower, and in category C you can do it in 1 year or 3 year, whatever. Okay, so this categorization is very helpful for stock control. Okay, then you have quality control. Quality control. Okay, if you find the defects, reasons, you can find that 80% of quality issues will be due to 20% of reasons. So what you can do, you focus on this 20% of the reasons, improve that. What will happen? Your 80% of your quality issues will go. We are going to see a problem on that. Okay, so that is its application. Clear? I'm quickly moving to the question. You can take question number 4.10, Pareto analysis. It's a very basic level problem. Okay, with this topic we will stop for the day. Okay, so take question number 4.10. Read the question. The following information is given about the type of defects during a production period and the frequencies of their occurrence in a spectacle manufacturing company. So there is a spectacle manufacturing company, and during the course of the process, the number of defects has been quantified or tabulated. Okay, we are going to see that. Defect, number of items. End frame not equidistant from the center. This is a defect. The end frame is not equidistant from the center. Number of defects or number of items is 10. Non-uniform grinding of lenses. The number of items is 60. Power mismatches, it is 20. Scratches on the surface, it is 110. Then spots or stains on lenses, how much? 5. Then rough edges of lenses, 70. And frame colors, shade differences, 25. Okay, so just a tabulation of the errors. Now what is the requirement? Required to prepare a frequency table so that Pareto chart can be constructed for the defect type. Also identify the key areas of focus. Okay, just see, it's a very simple question. Just observe how it is being done. Okay, so you can write the heading statement showing Pareto analysis of whatever defects. Pareto analysis of defects. Okay, right. You can have defect type, then number of items. Okay, then you have percentage of total items, then cumulative total in percentage. Okay, so defect type, what is the first defect type? Scratches on the, we are taking in the order of the increasing order. Okay, first we will take the items with maximum. Okay, so I am taking scratches on the surface. How many instances have been found? 110 items. Okay, then next is the edges of lenses. How many instances? 70 instances. Then non-uniform grinding. Non-uniform grinding of what? Lenses. How many instances? 60 instances. Okay, then frame colors shade differences, which is that frame colors shade differences, 25. Frame you have 25. Then next is, what is next? Power mismatch in 20 cases. You have 20 cases. Then end frame not equidistant from the center. How many? 10. Then last one, what is that? Spots or stains on lenses, 5 cases. Spots or stains, 5 cases. What is the total number of cases? Okay, 110, 110 plus 70 plus 60 plus 25 plus 20 plus 10 plus 5, that is 300. Okay, now what you have to do, you need to find out what is the total percentage of each of these defects to the total. Okay, so here 110 divided by 300, this will constitute to 36.67 percentage. Then 70 on 300 will be 23.33 percentage. Then you have 60 on 300, this is 20 percentage. Then you have 25 on 300, this is 8.33 percentage. Then 20 on 300, it is 6.67 percentage. Then 10 on 300 will be 3.33 percentage. Then 5 on 300 will be 1.67 percentage. Total should be 100 percentage. Okay, now if you take the cumulative total, what is the cumulative total? Here it will be 36.67. Then 36.67 plus 23.33, it will be 60%. Then here it will be 80%. Then 88.33%. Okay, 88.33 plus 6.67 will give you, this is 95%, and here 95.3.33 will be 98.33, and here it is 100%. Okay, now identify the key areas. This is the Pareto table. Okay, Pareto table. Now identify the key areas where the company should focus. If you see, scratches on the surfaces constitute 36%. Then together with rough edges on lenses, cumulative 60. And then non-uniform grinding lenses together, it comes to 80. Okay, so you can write a conclusion. Okay, 80% of the defects, 80% of the defects, 80% of the defects are contributed by 80% of the defects are contributed by three defects, that is scratches on the surface, comma, rough edges of lenses, and non-uniform grinding of lenses, Therefore, according to Pareto theory, the company should identify these defects as high priority defects, and should look for eliminating bar minimizing these errors, these defects, minimizing these defects. Okay, the remaining how many? 2, 4, 5. 5 defects. The remaining 5 defects cumulatively constitute only 20% of the total defects. 20% of the total defects. Therefore, it is not worth to spend too much management time and focus on these 5 areas. Is it clear? So 3 defects constitutes 80%. You focus on that. And the balance 20% is constituted by 5 defect areas. You give less priority to that. Okay, so this is how you apply the Pareto analysis. Okay, now in this chapter we have a small topic left out, that is environmental management accounting. It's a very small topic which we will see in the next class at the beginning. Okay, and then after that we will move to the traditional topics in strategic cost management, that is your marginal costing, then pricing decisions, etc. So from next class onwards, it is going to be a pakka costing class, because so far whatever we have seen, except for this particular chapter, the first 3 chapters basically it was more of a theory in nature. Okay, whereas the problems were very limited. Generally, if it was a regular class, I would have preferred to take the conventional topics first, then take these topics at the end. But since it is a revision class, I wanted to go in the institute material order itself. So I took this order. I know the first few topics or some chapters were a little dry because of more theory kind topics. Now in the coming classes, we'll be taking core costing topics like marginal costing, price and decision, transfer pricing, then ABC costing, budgetary control, standard costing, etc., which all will be very fascinating and exciting. You will be doing more number of problems in that. Okay, so we will stop for the day. Thank you very much. Thank you.